Let's be real, if you've spent any time at all in the crypto space, you have definitely seen them. I'm talking about those absolutely massive, almost unbelievable return percentages. You know, the kind of numbers that make your traditional bank savings account look like a total joke. But what do they actually mean? Today, we're going to pull back the curtain and really unpack the promise of these high yields in crypto.
So let's just get right to it. You're scrolling online and you see something advertised, say 74% APY. Your first thought is probably, is that for real? How is that even possible? And you know what? That's exactly the right question to ask. To answer it, we first need to understand one of the most powerful concepts in all of finance. It's the secret sauce behind it all.
And that secret sauce? It's called compounding. This is where the magic really begins. It's the whole idea of your money starting to make more money, all on its own. If you really want to get what APY is, you have to start here, because compounding is the engine that drives those huge numbers we see.
Okay, let's start with the absolute basics. Simple interest.
Imagine you lend a buddy $100, and you tell him you want 10% interest for the year. At the end of the year, he pays you back your original $100 plus $10 in interest. Total, $110. Simple, right? The key is that interest is only ever calculated on the original amount. But now, let's add a little twist. What if that same 10% interest is compounded twice a year? So after the first 6 months, you'd earn 5% on your $100, which is $5. But here's where it gets interesting. For the next 6 months, you're not earning interest on just the original 100. No, you're earning it on $105. And that's how you wind up at the end of the year with $110.25.
Just 25 cents. I know. It doesn't sound like much, does it? But that extra 25 cents, that is everything. That right there is the magic of compounding. It's the interest you earned on your interest. And that tiny little effect is what can snowball into something incredibly powerful over time. And this magic, this little snowball effect, is the key difference between two terms that you absolutely, positively need to know: API and APR. Seriously, understanding this showdown is the key to knowing what you're actually earning or what you're actually paying. Okay, so let's break it down. APR, that's the annual percentage rate, is just the simple, flat interest rate. It does not include the effects of compounding. Think of it as the sticker price. APY, on the other hand, the annual percentage yield, does include compounding. That's why APY is the true, honest-to-goodness measure of what you can earn on your money. And it's why APR is usually used to show you the simple rate you'll owe on something like a loan. And this isn't just some abstract theory. You see this in the real world constantly. When a bank wants your business, when they want you to deposit your money with them, they're going to shout about that high APY from the rooftops because it includes compounding and just looks better. But when you're the one borrowing money, suddenly they might focus a lot more on the APR. It's the same principle, just from opposite sides of the deal.
Now, I'm going to flash the official formula on the screen, but please don't panic. There's not going to be a test later. All this formula is really showing is that the more frequently your interest compounds, the N in the formula, the higher your APY is going to be. So daily compounding gives you a better APY than monthly compounding. But honestly, there's a much easier way to think about this. Just forget the math for a second. The mental shortcut is this. You start with your base rate. That's your APR. Then you sprinkle in the magic, the power of compounding. And what you get out the other side is your APY, your true, actual yearly return. It's that simple. All right, enough theory. Let's get to the good stuff. Now that we know what APY is, where in the wild world of crypto can you actually find these opportunities? And how on earth are they able to offer such high numbers in the first place? Well, when we talk about earning yield in crypto, it's not just one thing. There are actually a bunch of different ways you can do it. You have things like staking or yield farming, which are more about actively participating in a network. And then you have simpler methods like crypto savings accounts or lending plans that feel a lot more like what you do at a traditional bank. Now, you might be looking at these numbers and thinking, okay, a 12% savings account, how is that possible? Well, it's a mix of things. For one, a lot of new crypto projects offer really high rewards to get people in the door. Decentralized platforms can also be way more efficient than old school banks. And frankly, investors are also being paid for taking on more risk. That's how you can see numbers like 4 to 6% just for staking a major coin like Ethereum, or even get into the double digits with something like yield farming. Okay. This all sounds pretty amazing, right? And the potential rewards are definitely there. But
And this is a very big but. This is crypto, so we have to have a serious reality check. With any shot at a high reward, you have to understand both the promise and the peril.
So first, the good stuff, the pros. I mean, the number one draw is obvious, the chance for way higher returns than you'd find anywhere in traditional finance. This can create some incredible opportunities for passive income. Plus, you get to play with these cutting-edge financial products, and a lot of them are surprisingly flexible.
But you have to weigh that against some pretty significant risks, and you really can't ignore these. First, the crypto you're earning yield on can swing in value like crazy. The platforms themselves can get hacked. The rules and regulations are still being written, which creates a ton of uncertainty. And maybe most important, those super high APY rates, a lot of the time, they're just promotional teasers to get you in, and they won't last forever. And all of this really boils down to one simple, crucial piece of advice. Doing your homework is completely non-negotiable. If you see a platform offering an APY that seems insane, you have to ask why. Dig deep. Check its reputation, check its security, because when your money is on the line, trust is everything. Which brings us to the final, most important point. Now you know what APY is, you know where it comes from, and you know the risks. So the next time you see one of those sky-high APY numbers, don't just get blinded by the percentage. I want you to stop and ask the right questions. What asset am I actually holding? How safe is this platform really? And where exactly is this yield coming from? Answering those questions is what really matters.